Mortgage rates and home prices are clearly connected, but not always in the way that people expect. Today, we're going to walk through 25 years of data to see when rates actually moved prices, when they didn't, and what it all means for today's home buyer.
Well, Jeb, let's talk about what people expect, including certain people like this people right here, because we have a few listeners who've been around from the very beginning and like to point out that Josh was of the belief that if rates went to 5.5 or higher, that we would have a correction in home prices. So there was a common belief there that rates go too high, massive decrease to affordability, and then home prices have to come down. We have not seen that. So our friend Lance Lambert over at Resi Club Analytics, they went back at 25 years of data and they studied the correlation, not between home prices, but between mortgage applications and interest rates. So when rates are up or rates are down, what does that tell us about home buyers? Are they in the market? Are they out of the market? We're going to go back to like around 2000, look forward on this. And then we're going to look about every 5 years at those periods. And it's been very different. And you're going to see that it's much more complex than just mortgage rates. And we're going to see what other things go into that and what it can tell us about today's market.
Well, Josh, I don't like that you said we're going back 25 years and then you said we're going back to 2000. Because I think 2000 was like 5 years ago, not 25 years ago. So that makes me feel really, really old. But let's talk about 2000. 2000 was before I got in the business. I started in the mortgage real estate business in late 2002, early 2003. So this was a little bit before my time, but I caught the tail end of the time that we're going to be talking about here. So let's talk about what happened in that 2000 range. So the early 90s was the savings and loan crisis, right? So, high rates, a lot of craziness in the market, and then things kind of settled down. Credit became a little bit more available. We're headed into 2000. Market starts to pick up. What are we looking at? I'd like to take a minute and just say thank you for watching. If you're finding any value in our episodes at all, make sure you hit that thumbs up. Consider subscribing to the channel if you haven't done so. And if you like this content and want to find a way to kind of pay us back, if you will, somebody just recently asked that, make sure you rate us and review us on whatever platform you're listening to us, because that does go a long way. And lastly, make sure you share with anyone you know going through the home buying process. Thanks.
Well, as hard as this is to believe, a mentor of mine, one of the best real estate investors I know, local to California, he's actually moved to Florida, so he's local to Florida now. But he wrote something, a giant report, like a 300-page report in 1997 called The California Comeback, Why Home Prices Will Double in the Next 5 Years. And people thought he was nuts. So you think about this. If you're listening from around the country, everyone knows that California real estate is always in demand. People always want it. Well, after the S&L crisis, after that little foreclosure wave, after that dip we saw in prices, there was this belief that home prices are never going to do what they did in the 70s and 80s ever again. We've seen all the appreciation, and it'll just be normal, meaning home prices will keep pace with inflation. If inflation's up 3%, home prices will be up 3%. To give it some additional context, around that time, I bought my very first property here in Huntington Beach. We got seller financing on that at 6.875%. And I remember distinctly telling my wife, my fiance at the time, I said, we are never going to refinance this loan. This is as good as mortgage rates ever get. So that gives you that context of where we were coming from. It wasn't 1982 where rates were 16 to 18%. People were taking 14% adjustable rate mortgages. It wasn't, that late 80s, early 90s where 8.5%, 9.5% rates were normal. At 6.875, we're like, this is pretty sweet. We got a nice setup. On what we actually saw, we had some really good years in the late 90s in the NASDAQ, in tech stocks, and then you had the dot-com crash, and the Fed really came in.
Did we actually have a dot-com crash, or was it more speculation than it was a crash? I mean, I guess, yeah. I mean, the dot-com
it's a different episode. The dot-com bubble,
sure.
It was really narrow, but the Fed came in and supported the market, and we had rates go much lower. So that takes us to really the first little era that we want to talk about is 2000 to 2006, where we had a couple of things coming. The Fed stepped in post NASDAQ crash, brought rates to a low level. So a lot of people were refinancing, lowering their housing costs, and home prices started going up. You started seeing speculation. I had been in the business 3, 4, 5 years, and this was the first time we started seeing people that had bought a home and it goes up 25, 30% in 2 or 3 years. And they either refinance, take the money out, pay off all their debts, or they sell it, buy a $400,000 home, because now they went from an FHA buyer with 3.5% down to a 20% down buyer. So you had things changing really rapidly. So there was just the market-based change of people having a lot of equity, rates lower, the economy is relatively good, people are making good money. And then that got to a point where we hit a wall with affordability, and the mortgage industry reacted with fancy products like deciding that option arms, negative amortization, adjustable rate mortgages are appropriate for everyone, not just for high net worth borrowers with lots of equity and great credit. And then we get into stated income, stated asset, then no doc loans where you just tell me you can qualify for this. I remember, so the biggest piece of this, what I'm saying is rates did come down through this era. So we had a run, let's say from that 6.875 where I was at, down to about 5.5, maybe even as low as 5%. So that's a nice tailwind. So we say mortgage rates led to increased volume. But what more important was going on, the economy was solid. People built up a bunch of equity, and mortgages were really easy. Everyone could qualify, and at relatively good terms, because mortgage lenders were really wanting to feel it. So we can say it was about rates, but it was much more about a solid economy. And then the gasoline on that fire of the solid economy was really easy lending terms.
Yeah. I mean, I specifically remember 2004-ish, somewhere around that time, Angelo Mazzillo from Countrywide at the time, biggest lender in the country, probably the biggest subprime lender in the country at the time, hearing him speak, and his whole thing was about basically everybody should be able to buy a house to some degree. Not specifically saying that, but basically creating products where anyone could get into home ownership to some degree and become, own a home. And with that, you saw a lot of the products that were created. And we could talk about, we're going to talk about what happened there, but that's kind of what added on to that whole thing was there was this belief that, hey, we need to make this available to everyone.
Well, it's not shocking, Jeb, that mortgage lenders would have felt that way, but we had bipartisan stupidity. Whether you are a diehard Democrat or a super conservative Republican, both sides were very of the mind that just what you said. Home ownership is correlated to many things, better stability, better family survivorship, higher wages. So this correlation, they decided that owning the home was the thing versus the people who achieved those things owned homes. So we went lower on credit scores, lower on down payments. And I'm talking in government loans. So quasi-government, Fannie, Freddie, actual government, FHA and VA. FHA and VA didn't much change their guidelines through that timeline, but Fannie and Freddie absolutely did. So when we look at that, it was really loose lending. So if we want to look at interest rates played a role. They kind of got the party started, but things got out of hand based off of loose lending more so than interest rates. So the next era, Jeb, that we have is the crash. Everyone very, very well aware. 2007 to 2012. So rates kind of started going up at the beginning of this because mortgages are risky, right? Who wants to invest in mortgages? So the yields have to go up. The government figured out we can't have this. So government intervention, quantitative easing, other tools drove rates really low. So from this time frame, those were the lowest rates that we've seen. We started seeing refinances in the 4s for a 30-year fixed. And people who owned a home and had built up equity and didn't lose their property, didn't lose their job, were like, this is amazing. I can lower my cost of ownership. But anyone on the outside at that time, I just remember there were a million different excuses or reasons why people didn't want to buy a home in that time. I bought the first house that I flipped in October of 2008. People go, well, you're crazy. People told us we were crazy at that time. And I said, the house sold 2.5 years ago for $675,000. We just bought it for $265,000. I can completely renovate it and rent it out for more than what the financing costs for the 100% financing of buying and renovating the property. So to me, there's zero risk. But that wasn't the way. That was someone very close to the market who watches, who knows numbers, and that's the way I felt. Nobody else felt that way. They're like, ooh, there's going to be another leg down. Don't try to catch a falling knife. This is going to be worse. And that went on for a long time. well past, 2011, 2012. In 2010, we had the Obama era incentives to homeowners. They gave tax credits. So what happened is 2010, we saw an uptick in sales volume and home prices because people were incentivized, especially late in the year, to take advantage of those credits. Well, all it did is it pulled forward the demand, and we saw an equivalent dip in 2011, 2012. So this era was characterized by really low rates, much tighter lending standards, right? You had to qualify. Like, this was full doc, many overlays. Every lender had overlays where very few have them now. So when we're looking at that, we went from loose lending and good rates to really good rates, but very tight lending. But most importantly, just the market psychology. No one thought ownership was great. And even those that did, many of them had just lost a home. So they had a foreclosure on their record. They couldn't buy if they wanted to. So most people didn't want to. Many of those who would have been willing to had lost a home and were unable to buy. So that, again, how much did interest rates play in there? It wasn't going to fuel a bunch of mortgage applications and people coming into the market because sort of the animal spirits of the market at that time were negative towards housing.
Well, let's not forget that even though the people that wanted to buy, like you said, even if they didn't have a foreclosure, the products weren't available that some of these people could have used, in the previous 5 to 7 years to get into those mortgages, right? I mean, a lot of people in the 2004, 5, 6 era were using adjustable rate mortgages, 2-3 year loans, interest only loans in order to be able to qualify for these properties. And those essentially went away. I mean, not essentially, they went away.
They did.
In 2008, 9, 10. And there were people, I was still doing loans at this time and frustrated as hell because people would call me and get mad at me because they couldn't qualify to buy a home because either, the products weren't there, they didn't have the income, that stated went away. All of the things that people were used to getting disappeared. And now all of a sudden it was my fault on the mortgage side. And I'm like, listen, guys, I'm the messenger here. And honestly, part of the reason I got out of the business was because the pendulum it swung from one side to the other without stopping in the middle. And that middle ground is essentially where we saw the next era that we're kind of headed into.
Yeah. Before we jump to that 2013, I'll give you probably the best example. I have this one will stick in my brain till the day I die. In about 2011, when rates were really low, I talked to a lady. She's about 70 years old, retiree in San Francisco. She had a duplex. She had a small pension, Social Security, and the rent from the other side of the duplex. When we calculated it all out mortgage-wise, she had a 70% debt-to-income ratio. We were going to take her from 7.5 to 4.5 and free up about $600 a month of cash flow. And we couldn't do that loan. Pre-2007, you remember, DU would approve rate and term refinances for people with good credit at like 70% debt to income ratio. So it's rate and term. It's saying, hey, I don't know how in the world this person's making this payment, but they are. If I drop their payment $300, $400, $500, they're going to continue making the payment. So the things that you were talking about, that to me is the most strongest example that I will never forget. That lady could not understand why I couldn't loan her money to drop her payment $600.
Well, I'll give you another example for the listeners out there. People like stories. A friend of ours, his father, who was an engineer, worked in Long Beach, made really, really good money, had a couple $1 million in the bank, and he was looking to buy like a $500,000 property up in the mountains. And basically, he qualified well on paper, so on and so forth. He was putting, 20, 30% down. And for whatever reason, they were giving us an issue with something on the qualification. I don't remember 100%, but I looked at it and it was like the guy had 5 times the property value in his bank account. I'm like, what risk is there here on this whole thing? But it was just because the lending standards had gone so far in the other direction that the market was just so cautious that it became a problem. Even with low rates and everything else, it kept, volume probably lower than it would have been had some of these products been available.
Yeah, it's an interesting reminder of times that hopefully are behind us forever. But let's look at that next era, that 2013 to 2019. And I would refer to this as the Goldilocks era. For anyone doing mortgages, looking to buy homes, sell real estate, this was a great time. Affordability was high. The economy started improving, so people were getting a better feeling about this, and rates were still low. We kind of mentioned that in affordability. Prices had not recovered much. Rates were still very low. People were feeling better about the economy. So what did we have? We had 5, 6, 7 years in a row of 4 to 6% appreciation, which that's solid for homeowners, especially coming off of an era when homes were probably underpriced. They had overcorrected post 2007. So when we look at that, it was a great time. So were the rates the thing that were driving there? They weren't necessarily the driving factor, but again, affordability is important. Home prices were reasonable and rates were low. So almost anyone who wanted to buy, even in high cost areas like Southern California, most, not even, I mean, if we go back, I don't even have the numbers. I wish I had it right in front of me right now, but I'll bet you in 2015, affordability as measured by the NAR was probably over 50% in Southern California, which now it's like 12 or 15%. So meaning we had three times more people capable of buying even in high priced markets. So it doesn't tell us a lot when we just want to look at interest rates in isolation. You got to kind of look at everything there. Where are home prices? So prices and the interest rates, but then also how are people feeling about the economy? Do they have strong jobs? Do they have savings? Do they have good credit? Are the debt to income ratios in line? And that was probably the greatest era, at least in my 30 years in the business for homebuyers. If we want to go back to the 60s, I'm sure there was a better time to get into the market. But that 2013 to 2019, anyone who bought in at that time has done very, very well.
I bought in December of 2012. It was a short sale, probably one of the last short sales in the community that I live in, if I'm honest. It took 6 months to do. We went under contract in June of that year, July of that year. It closed in December 24th. By March of that year, not even 4 months later, 3 months later, the market had already turned, and that property was probably worth $50,000 or more. From where I paid on it, which is probably about 10%. I mean, I paid $500,000 for it. Those properties were selling at $550,000. Crazy. I mean, just the timing. It's not like I knew something in the market. For me, again, I've talked about this several times. It was the right time. My wife and I getting married, getting ready to have our first kid, or we actually had our first kid at that point. Talking about a family, just looking for more space. It was the right time. I wasn't thinking, hey, home prices are about to go crazy from here. In fact, I didn't really know where home prices were going. I just knew, hey, listen, I'm paying $2,200, I think at the time for my rent payment, and my mortgage payment was going to be not much more than that. But then property taxes, insurance, it was about $3,500. And I was like, it's kind of a no-brainer. Like, why wouldn't I make this move? And from there, it's kind of history, but it
best financial decision of your life.
No, it truly was, because I mean, we could talk about when we sold that property, what we sold it for, but that was the driving factor at that time. It wasn't, for me, it wasn't really a rate thing. It was about, it was just a timing thing. Affordability was at a really good point versus where rents were at that time. So it all kind of made sense.
Well, let's transition from there now that we've done the walk through history, the last 20 years, because most of our listeners are 30 to 45. So, at the beginning of that time frame, you're 20, 25 years old. Some were in your teen years, and you don't have any recollection or memory of it. So that's the 15-minute history lesson. You don't need any more. Let's look at recent history. So we all know what happened after 2019. COVID breaks out in early 2020. Massive government intervention drives rates to extremely low levels. And what do we see? Home prices up 35 to 50% over the next 2 years. So from 2020 to 2022, those ultra low interest rates, I think it's fair to say that was the biggest driver. So that was a time when we can say mortgage applications, so refinance and purchase mortgage applications through the roof. But it wasn't the only reason. So we had artificially low interest rates driven by government buying of treasuries and mortgage-backed securities. And that massively increased affordability. We still have, at the beginning of that window, reasonably priced homes, and it pushed everything through the roof. There are other factors. I mean, everyone would acknowledge the ability.
No, people turning prime buying age, right? At that time, there was a massive demographic not shift, but there was a population, I don't even know what the word I'm looking for here, Josh, is. There's a lot of people turning prime buying age that were coming into the market at time when rates went low. A lot of demand was pulled forward, as we've talked about many times, because of those low rates. And that essentially allowed the housing market to go bananas, on top of, work from home and all of the other things. There were so many different factors in there that pushed people to buy homes.
So the work from home was on two fronts. The fact that, hey, if I have to work at home, do I want to be in an apartment, or I make enough money and I'm trapped here 24 hours a day? Do I want to go buy a house or a condo? A lot of people said I want to buy. Then said, hey, my company is here in the Bay Area. A condo is $900,000, but they're letting me work remotely. I can go to Boise and buy a bitchin' house for $350,000. So multiple underlying factors there that made this more optimal for many people. As soon as we got over the hump and people realized the economy was going to be okay, you were going to have your job, you didn't have anything else to spend money on, and you were going to be at home for the foreseeable future with a very low interest rate, everybody jumped into the market. So that continued until early 2022. We started 2022 with rates right at about 3%, and we ended up over 6% by the end of the year. They doubled within 1 year. So that is the most recent era here that you are all looking at buying into, and you feel that pain. So what have we seen? That, again, we're talking today about the correlation between interest rates and purchase volume, but then sale prices. So we've seen, do you remember during the COVID years, Jeb, we were over 6 million in annual sales, right? Low sixes.
At the beginning, yeah, no, we're like 6.5 million.
6.5. And the most recent numbers, most recent annualized numbers that we've just seen from the NAR are 4 million. So we're 35% less. So if we look at the application data, even though purchase applications are up over the last 12 months, they're up from a very low level. If we go back and look at the 3-year chart, we're massively down, even though year over year we're up. So when we look at that, you say sales volume is down, but it hasn't impacted prices. And why has it not impacted prices like many people thought that it would? Like we led off the show, I thought if we got above 5.5, it's going to be a really hard time for prices. Well, the biggest reason is the lock-in effect, and not so much the lock-in effect, the lock-in benefit. People who bought during COVID or refinanced during COVID and owned a home and enjoyed 30 to 40% appreciation above and beyond what their home had appreciated before that are sitting on a ton of equity at a really low interest rate, and their alternatives are not good. So prices, not sales volume, prices are far more controlled by supply and demand. So there's a lower supply of homes. Even though we may be almost back to 2019 in most parts of the country, supply is still relatively low because most people, they have their housing needs met and satisfied at a very good level. You had a need to move a couple of years before you guys moved. You outgrew that house, but you stayed there because there was going to be sort of a barrier to cross for you to take a much higher interest rate at a much higher loan because the prices appreciated. Many people are in the same boat. So have interest rates been an important component for sales volume being down? 100%. Probably the biggest piece. Home prices are at least 50% of that, but interest rates are at least 50% as well.
No, I mean, yeah, 100%. I mean, we moved in 2023, right? I mean, we should have moved during the pandemic era, but honestly, I was happy. I was happy with my mortgage payment. I was looking at that thing going, hey, listen, I could rent this house for $2,000 more than I'm paying in my mortgage payment. Why would I ever sell this? And then it just got to a point where it was like, it was a lot. You realize, hey, the kids are growing, you're stuck in this house and just all of the things that people go through. And it just became, again, the right time to make that shift. Now we made it when interest rates were probably towards the peak. I mean, we interest rate at 7%. At the time to buy the house that we're in now. But again, partly impacted by rates, partly impacted just by the market in general at that time. Why we made that move, I don't regret it. In fact, I mean, again, it was the right move for our family. Since then, rates have come down, and what we've seen, Josh, is demand pick up, inventories picked up as well, but we're still battling some of the same things that we were battling prior to the pandemic. People have very short memories and don't realize as we were heading into the pandemic era, we had low supply of homes. We weren't, at least here in Orange County, we weren't flourishing with just so many properties. There were still multiple offer situations. Still, I go back and occasionally and watch videos that I was doing at that time because, again, I even forget. And the same things I was talking about during the pandemic were things that we were talking about prior to the pandemic. And it was just, a more normal market versus the craziness that we saw then. So with that, Josh, let's transition into talk about rates now, right? We're sitting in the low 6%. There's this belief, depending on who you follow. I mean, Fannie Mae thinks, we're going to end the year somewhere about where we are now, maybe a little bit higher. Whereas they see next year kind of moving us down towards that 6% number. How will that impact home sales? How will that impact home prices? How will that impact affordability? There's a lot of factors going in here. It's definitely not the only thing, but it's going to have an influence.
We've seen over the last 90 days, purchase applications have picked up considerably. So remember, put it in context, still very low relative to 2020 and 2021, but much higher than 2022, late 2022, early 2023 and 2024 when rates were near that 7% range. So it doesn't move the needle for everyone, but this is the thing that I would say. We had a comment in a YouTube video about a month or so ago, and someone said, it's not about rates, it's about home prices. Until prices come down, no one's going to buy. And you're like, okay, that's a massive generality, but they did the math. And if I'm remembering them incorrect, I'm just trying to do this quickly in my head. But they basically said if rates went down to 5.5%, the price range that they were looking at, that would only drop the payment 17%. That's not changing anyone's mind. And I said, okay. If we had, when things were super affordable, 6.5 million of the widgets sell every year. And then at full price, we're at 4 million widgets. If we drop the price 17%, many more of those widgets are going to sell. That's just common sense. So does it mean that every person can get back in? Does that mean that affordability at a 17% lower monthly payment goes back to 2020 or 2019 or 2021? It absolutely doesn't. So we're probably not going back to 6.5 million home sales anytime soon. But is that number 4.5, 5 million, 5.1 million, 4.8 million? I don't know. But we are of the belief that rates are going to stay in this range and trend lower over time. And if that is the case, I think we're going to see a new normal. The low end is shown to be about 4 million in home sales annually. And that high end is probably 5. We probably don't get above 5 just with where affordability is right now. So when we look at it going forward, what does it tell us? Affordability should improve, but demand and a little bit of supply, because you've pointed out a million times, 75%, 80% of sellers are buyers. So supply and demand, we're in this sort of sideways trending market where you could see on a real basis home prices decrease in value, meaning that inflation's at 3% and home prices go up 2%. Well, they in real terms, then home prices dropped 1%. Maybe it's a 4% and it's 2% appreciation. You had 2% real. We're talking about more reasonable long-term numbers. So everything that we're looking at, anyone who looks at the current data and says, I see a crash coming, is out of their mind. I can tell you what the formula would be, or a couple of different formulas for how we get there. But the economy would have to weaken considerably. You would have to have inflation remain high, unemployment go to a very high level where we have that stagflation. Just yesterday, Jeb, you and I were looking at the last number for the Atlanta Fed's GDP nowcast of GDP forecast for Q3, and it's almost 4%. That's not that type of economy. So can things change? Can things change fairly quickly? Yes. But what we're seeing is sort of this muddle through, more of the same, slightly higher sales volume, reduced affordability, but hopefully improving for those of you who are in the market as rates continue to trend ever so slowly lower.
Yeah, and let's not forget how much equity is in property, right? I mean, that's something we didn't even discuss. I think if there's anything you take away from today's episode, it's that you're buying when it's the right time in your life. You're not focusing on picking the top or the bottom in interest rates or prices. It's all about finding the right house, the right location, having job stability, relationship stability, having a longer term time horizon. Again, that last property that I sold in 2023, I bought in 2012. I was in there 11 years, which at the moment, Josh, I think is about the average tenure for people being in a property. It used to be like 6 or 7 years. And then it kind of went up to 8 or 9. And now it's 11 years. People staying in their properties longer. You have to have that mindset, right? Time is will benefit you greatly when it comes to owning real estate. So I think that's the focus. But if you're looking to buy a home, get started with the process, have questions, there's a link in the description of the video. You can get in touch with Josh and myself. Josh, what are your final words? What are your thoughts on just what people should focus on at this point?
Exactly what you said. Focus on your situation. Make sure it is right for you and that you can have a longer term time horizon. Things can happen. You can have health issues, relationship issues, unforeseen things can happen. So we plan for the best with the knowledge that we have right now. I do think things will continue to generally improve slowly over time. I'm not expecting rates to drop to 3% anytime soon unless we get back to a situation where the government has to jump in with both hands. And hopefully we don't ever see that again. So we should trend lower. We've gone through the numbers before. Seeing rates in the fives is not an unreasonable thought or expectation. It could take longer than we think. And they don't generally just stay in one place. Maybe they go down to 5.25 and they trend back up over time when the economy heats up to 6.5. But have that long-term time horizon. Most people want to own a home. Home ownership rates plus or minus 65% in the US over the last 50 years. If that is you and it's the right time in your life and you have a long time horizon, do the work, do the research, and make sure that you're making wise decisions for yourself. And if we can help with that, reach out, use the link in the description down below. We'd love to help you run through the numbers. Some of the people, when we run through the numbers, Jeb, the answer is, hey, you know what? We're not quite there. We need to save a little more money. We need to pay some debt off. Maybe I need to wait till I get that promotion in the first quarter or my fourth quarter bonus comes in. Any of those things, we can help during that consultation of going through what do we know today? What's going to happen over the next 3 to 6 months? How are things going to change? When is the right decision for you?
And use that link in the description to get in touch with the team. If you found any value today, make sure you hit that thumbs up, subscribe to the channel. Until next time, adios.
Amigos.